Good morning, Trinidad and Tobago, and welcome to the Bourse Report. This week, we take a look at the most recently released results of NGL, the lone pure-play energy stock listed on the local exchange. We also review the most recent performance of First Caribbean International Bank, whose stock price has advanced some 30% for the year thus far. Turning first to NGL, for the year ended December 2015, NGL reporting an earnings per share figure of $2.40 versus a loss of $4.87 in 2014. NGL would have also declared a final dividend of $1 per share, payable on May 6, 2016, bringing total dividends declared since its IPO to $1.50 per share. While NGL's full-year EPS was a healthy $2.40, a closer look at the numbers is warranted. Firstly, more than 60% of EPS was attributable to an impairment gain of about $235 million, recorded in the fourth quarter of 2015, related to its holdings of Phoenix Park Gas Processors Limited, or Phoenix Park shares. The gain was a result of a 27% increase in the terminal value of Phoenix Park, which effectively increased the valuation of NGL's holding of the shares. These impairment revisions, however, are seen as one-off in nature and do not reflect the operating performance of PPGPL. Secondly, NGL's share of profits in 2015 from its investment in Phoenix Park was a significantly lower $136 million when compared to the $345 million earned in 2014. Again, a sharper focus reveals that fourth quarter share of profits may have been affected by a one-off expense of a significant nature. And as we turn to our first chart, which compares fourth quarter NGL production data and pricing data to that of the third quarter in 2015, you'd see it on your right-hand side of the screen, we observed that estimated NGL Mont Value price basket in both the third and fourth quarter of 2015 were broadly similar at around US 70 cents per gallon. Export data published by the Ministry of Energy also showed an increase in barrels of natural gas liquids exported from 97.2 million barrels in the third quarter to just over 101.6 million barrels in the fourth quarter. These two data points would suggest, all other factors held constant, that Phoenix Park's share of profits attributable to NGL in the fourth quarter should have been at least equal to, or probably a bit more higher than, that recorded in the third quarter of 2015. With a lack of available public financial data for Phoenix Park then, we may infer that Phoenix Park incurred a significant one-off expense in the fourth quarter of 2015. Given that NGL was still able to pay a significant dividend of $1 per share to shareholders, we may infer that Phoenix Park was still able to pay a healthy dividend to NGL despite reporting lower share of profits. And this in turn would suggest that the one-off expense incurred by Phoenix Park in the fourth quarter was likely non-cash in nature. Looking ahead and turning to our second graph, NGL's sole investment interest, Phoenix Park, continues to operate in an environment of lower prices of its butane output, which is down 8.3% year to date, while natural gasoline and propane have advanced 3.4% and 17.6% respectively. With crude oil prices expected to stabilize at between the $30 to $40 range for the remainder of the year, natural gas liquids prices, which are quite correlated to oil prices, are likely to remain subdued in 2016. Production and exports of NGLs from Phoenix Park may also experience a natural decline in the absence of significant new production coming online, which could be in the vicinity of 4 to 8%. At the current price of $19.05 and on reported earnings, NGL is trading at a multiple of just below 8 times. When adjusting for NGL's performance for the impairment gain and the inferred one-off expense affecting share of profits from PPGPL, adjusted earnings per share would be in the region of $1.18 to $1.20, with a consequent multiple of just under 16 times. Investors who would have purchased NGL shares during the IPO have benefited from a dividend yield of about 7.5% on the issue price, while the trailing dividend yield stands at about 7.9%. Importantly, NGL offers the favorable feature of a built-in hedge against the depreciating TT dollar currency via its US dollar earnings from PPGPL. This is indeed an attractive feature for medium-term investors, despite the still uncertain short-term outlook for energy markets. On the basis of an above-market average dividend yield and the currency hedging characteristics of the stock, Bourse maintains its buy rating on NGL. And turning quickly to First Caribbean International, for the first quarter ended January 31st, 2016, FCI reported an earnings per share of 16 cents versus its first quarter 2014 earnings of 11 cents TT. While interest income remained flat, total income expanded 6.4% due to an increase in operating income and a reduction in net interest costs. Loan loss impairments also fell about 75% due to improving loan recovery activity, as cited by the bank, with a subsequent increase in profit by about 45% or 79 million TT dollars. And looking ahead and turning to our final graphic, at a price of $6.50 and a trailing EPS of 45 cents, FCI is trading at a multiple of about 14.5 times, broadly in line with the banking sector PE of about 14 times. A return to consistent positive earnings due to lower loan loss impairments and a more positive outlook on the stock bode well for the stock in the future. These factors, coupled with the fact that FCI reports earnings and pays dividends in US dollars, would provide support for further price appreciation as local investors continue to seek access to US dollars and or hedge against the ongoing depreciation of the TT dollar. On this basis, Bourse places a buy rating on FCI. That's all for this week's edition. For more information, give us a call at 628-9100. Visit our website at www.bourseinvestment.com or email us at invest@boursefinancial.com. Have yourselves a great investing week. This has been the Bourse Report.